Every week, stocks hit new highs for reasons that aren't always obvious. That's why I break down those moves so you understand what's actually driving the market. Right now, the market is surging with a massive 183 companies making new highs. There is broad market participation. Investors are particularly rewarding companies that benefit from inflation, geopolitics, and long-term policy trends. Today, we're looking at Exxon and Lockheed Martin to understand what's behind those moves. One reflects how energy prices and geopolitics move markets. The other shows how defense spending and global uncertainty turn into steady earnings. By the end of the video, you'll understand why these stocks are winning and what that says about why the market is surging. Let's start with ExxonMobil. Trump's actions in Venezuela have put an interesting spotlight on the oil industry. ExxonMobil is one of the largest energy companies in the world. They produce oil and gas, refine it into fuel, and make chemicals that end up in everything from plastics to industrial materials. But this ain't the same Exxon from 5 or 10 years ago. After getting crushed during the last energy downturn, the company went through a massive restructuring. They cut costs, simplified the business, and got extremely disciplined about where they invest capital. That reset matters because today, Exxon is hitting new highs for a very different reason than in past cycles. This isn't about oil prices going up. It's about execution. Right now, the market is rewarding companies that profit from inflation, generate huge cash flow, and benefit from geopolitics. Energy checks all those boxes. And Exxon in particular has some of the lowest cost oil projects in the world, especially in places like Guyana and the Permian Basin. So when oil prices stay elevated or global tensions rise, Exxon doesn't just survive, it throws off cash. That combination of disciplined spending, strong assets, and a tougher global backdrop is why the stock is pushing new highs. Now, let's look at the numbers and see how that shows up in the financials. Exxon's financial story is all about efficiency. Since 2019, the company has taken out over $14 billion in structural costs, and it's targeting $20 billion in annual savings by 2030. That matters because Exxon can generate strong profits even when oil prices aren't ideal. And lately, they haven't been. Oil prices have come down, yet Exxon's margins are stronger than in past downturns. And that's because the business is simply more efficient. Most of Exxon's earnings come from its upstream oil and gas business. But what really matters is where that production comes from. The company's best assets, especially Guyana and the Permian Basin, are some of the lowest cost barrels in the world. That gives Exxon a huge advantage. When oil prices rise, profits surge. But when oil prices fall, these projects still make money while weaker producers get squeezed. So when you combine softer oil prices, strong current profitability, and plans to push efficiency even further, you get a powerful setup for future returns. Now, some of those returns get reinvested in high return projects, but the rest, that gets sent straight back to shareholders through dividends and buybacks. That mix of strong cash flow, controlled spending, and shareholder returns is exactly why Exxon is hitting new highs. Exxon is currently trading at around an 18 times earnings multiple, which is right in line with its long-term average. For my growth projection, I'm looking at a couple of factors. First, Exxon expects to grow production by about 3% per year. Second, you're getting a forward yield of roughly 5% through dividends and buybacks. But the biggest driver here is cost savings. Exxon's efficiency improvements add roughly another 6% a year. Put all those together and you're looking at 13 to 14% annual returns, which lines up with Exxon's own earnings growth expectations. If we hold the forward PE steady, we get a 90% total return over the next 5 years. And that's without assuming any oil price increases. That would add massive upside. My take? I really like Exxon here. The cost savings alone are a powerful return engine. And this is definitely a company I am going to dig deeper into. The biggest risk with Exxon is obvious: oil prices. Beyond that, there's also political and regulatory risk, something we just saw play out in Venezuela. Energy companies operate in a constantly evolving geopolitical environment. Negative changes in governments, regulations, or taxes could weigh on future profitability. Exxon just had the president of Mozambique at their campus, highlighting the political maneuvering necessary to secure oil contracts across the world. The takeaway? Exxon is a perfect example of how operational efficiency drives shareholder returns. Cost cuts alone turned an underwhelming 8% annual return into a market-beating 14% annual return. Now, let's look at Lockheed Martin, a stock hitting new highs for almost the opposite reasons. Lockheed is one of the world's largest defense contractors, building everything from fighter jets to missiles, radar systems, and space technology. The F-35 program is the backbone of their business. It's the single largest aircraft program in history and accounts for a huge portion of revenue. Even as Europe debates defense priorities, the long-term demand for these jets remains strong. And Lockheed is already planning upgrades and modernization programs that will drive revenue for decades. On top of that, Lockheed has a massive backlog, nearly $179 billion, which gives investors a lot of visibility into future sales. That's what makes this stock so resilient. It's not just rising geopolitical tensions. It's that governments need Lockheed's products consistently, year after year. The threat never stands still, and neither does Lockheed Martin. But these solutions don't come cheap, and that's exactly what we'll explore next. How does this demand show up in the financials? Lockheed's financials show a strong, predictable business on the surface. But there's a lot more beneath. Revenue is growing steadily, with mid-single-digit gains across most segments. The F-35 program in aeronautics continues to drive top-line growth. But the real story is the complexity of the business and how that affects expenses and profits. In Q2, Lockheed took a massive $1.7 billion charge related to the Aeronautics Classified Program, the Canadian Maritime Helicopter Program, and the Turkish Utility Helicopter Program. That's a huge swing in expenses we can't fully account for. And part of it is literally classified. The government could have literally just requested money, and we wouldn't even know. That lack of transparency creates real risk. Revenue visibility exists, but expense variability turns that into net income instability. What's more concerning is how management framed it. During the earnings call, they treated these charges as a cost of doing business, not something they can meaningfully improve operationally. That's a sign this risk isn't going away. Lockheed looks rock solid at first glance, but underneath, there's a lot of moving parts that can swing profitability. With that in mind, let's look at how this plays out in valuation. Lockheed trades at roughly 20 times forward earnings. That's above the long-term average of 15 to 17. Even with my concerns about management not emphasizing operational improvements, the company has steadily increased margins over the years. That's allowed profits to grow at about 10%, outpacing its more modest 6% revenue growth. If we combine the roughly 5% forward yield with a conservative 8% earnings growth, we get about 13% total annual returns. Plug that into our model, holding the forward PE steady, and we get an 84% return over 5 years. That comfortably outpaces the broader market. But there's a risk. If the forward PE reverts back to the mean of 17, that 84% drops to around 57%. My take? I still like Lockheed Martin as a stock. It has over 2 years of backlog, a long-term F-35 program, and a yield that compensates for its operational risks. But there's no urgency to buy now. Defense stocks are trading at a premium, and demand for them is normally weak, given that many investors avoid military exposure. I'm going to add Lockheed to my watch list and plan to pick it up when it's a little cheaper. We've already covered the key risks, unpredictable expenses, and the potential for forward PE compression. Let's jump straight to the takeaway. Lockheed Martin shows that even a company with strong demand and a massive backlog can carry hidden risks. Don't get too excited by revenue visibility. Operational complexity and expense variability can make profits far less predictable than they seem. Exxon and Lockheed Martin highlight two very different paths to market highs. Exxon shows how operational efficiency can turn a good business into a great one. Cost savings, disciplined spending, and strong cash flow turned an 8% market return into 14%, rewarding shareholders directly through dividends and buybacks. The takeaway here is clear. Efficiency isn't just a buzzword. It drives real shareholder returns. Lockheed Martin, on the other hand, demonstrates the power and the hidden complexity of scale and demand. A massive backlog and long-term contracts provide revenue visibility, but operational complexity and unpredictable expenses make profits far less predictable than they appear. Here, the lesson is that even seemingly rock-solid businesses can carry risks that investors must understand. Together, these stocks remind us that the market rewards both operational excellence and durable demand, but only when you account for the hidden risks along the way. That's it for today, guys. If you found this helpful, hit like. And since you stuck around this long, join me on Discord. Link in the description. I really do want to talk to you. Sorry guys, I was a little under the weather this week, so I'm not sure how the audio sounds as I'm struggling to hear myself talk. Thanks. Bye.